Hi there, and welcome to SEM's Market and Economic Update. Now, normally we only do these once a quarter, but we've heard from a lot of people saying, hey, we haven't seen much of an update from you. What are your systems saying right now? Obviously, there's a lot of good news happening as far as stock prices go, and we wanted to take a step back and say, well, let's look at an intra-quarter look at some of our economic models. So let me go ahead and get started and share my screen. You should be seeing the title slide there, and let's just get going. Now, this first chart that I have shows in orange the official GDP number. Now, this is one that I don't like to use, and I've talked about it for years, because the government's the only entity that's allowed, as far as economic numbers go, to take what happened over the last 3 months and essentially multiply that by 4 to give you an annual number. Now, so you're going to see jumps or falls between December and March, and they're going to multiply that, and you're going to see a really big number, a really small number, or something that doesn't really add a lot of value in there. So what we choose to do at SEM is we use the 1-year number, because that takes a look at where are we at today versus where we were at a year ago. And the reason I want to point this out before we dig into the details here is we're about to see a very, very large number, because they're looking at economic activity as of March 31st, where we're at on June 30th, and they'll multiply that drop by 4. So you're talking about maybe a 50%, 70% decline between those two numbers when you annualize it. But what we're focused in on is that blue line, because that shows where are we at versus 1 year ago. But one of the things that you'll see as you look at this chart is the dashed line is the long-term average growth rate of the economy. Now, what I think is important, even with the orange lines, which are annualizing numbers, we barely had any quarters up above the long-term average growth rate. And that's despite the Federal Reserve being very active from 2012 through 2015 as far as quantitative easing goes, keeping interest rates low until 2018, before they started trying to raise interest rates. And a lot of other things happening, and including the Trump tax cuts. And the blue line only spent a couple quarters above the long-term average this entire recovery. And so when economists and market prognosticators say, hey, we're going to get back to where we were at before, I say, where we were at before wasn't that great. We had some structural issues, and all COVID-19 has done is kind of accelerate things that were going to happen anyways. And now we have to rebuild and replace those things, in addition to good businesses that were harmed from COVID-19. So we got the basically two different economies. You have the things that were weak and were going to fail anyways, and then the things that need to recover. And what we're looking at is heavily indebted borrowers are already defaulting on their debts, and they were going to do that anyways. You're looking at firms filing for bankruptcy. They were going to file for bankruptcy anyway. You look at weaker businesses failing. That was going to happen. And so that is a hit to the economy that won't put us back to where we were at before, regardless of what happens with the virus. We're not going to get back to where we were at before. And so people keep assuming that we're going to not only get back to where we were, but we're going to exceed that. And that's not going to happen. And that's what we have to keep in mind, is just because the economy starts to turn around, we're not going to get back to where we were. Those structural issues were exposed, and now we have to face those. And so this recession, regardless of what caused it, is going to be a long recovery. It's not going to be something that just snaps right back. And so we have to keep that in mind. Jumping ahead to the next slide, this is a look at our economic model, and I think it paints a more clear picture, because we really have 3 states. We have an accelerating growth rate, a flattening growth rate, and we have a declining growth rate. What you'll notice there is in early 2019, our economic models started picking up on things. Now, this is a year before COVID was even known, and we saw the economy decelerating. So the type of economy that everybody is longing to get back to is an economy that was already showing a slowdown. Now, the nice part about our model and using this, which we update every month on the blog, is It's based on data. It's not based on somebody saying, well, based on, the activity I saw at the shopping mall this weekend, I believe we're going to see that. It's hard data. It's designed to get pretty quick data. We have already had all of April's data has been incorporated into the model, and you can see it's a very big drop on a 1-year basis. We're talking about a 3% decline. It's probably going to keep accelerating to maybe a 5% decline, but it's not going to get us right back to where we were at before, given all the structural damage that has taken place. Now, let's take a step back here and let's look at what's really driving the market. And it's my number one rule to investing is not buy low, sell high. It's the stock market's going to move in cycles, both overreactions to the upside and overreactions to the downside. So we're going to see the market move in cycles. And what we saw happening in March is you saw a very quick panic as everybody said, oh my gosh, we're shutting down the economy, this thing's terrible. And everyone panicked. For about a 3 or 4 week period, you saw the market's not functioning very well as far as some people thought. In my opinion, they did what they were supposed to do. We had circuit breakers kicking in, keeping the panic at a controlled level. And we actually saw stock prices reflect what the fundamentals, the earnings of the economy said they should be at for about 2 days. And then what we saw happening was everybody kind of said, okay, maybe it's not so bad. And they started buying stocks. In my opinion, based on doing this for 25 years, is we're at a stage where investors are in denial. We saw the panic, and now they're saying, hey, everything's reopening, the virus isn't that bad. And they're denying the structural issues that I mentioned at the outset, the bankruptcies, the heavily indebted people defaulting on their debts, the small businesses closing, the permanent job losses that are going to take several years to recover. I'm looking at probably 9 to 12% unemployment by the end of 2021. So 18 months from now, we're still going to have a very high unemployment rate. There's just not enough underlying activity yet to get those jobs replaced. And it's something that we're going to have to face. As that sets in, this is why I say everybody's in denial, we're likely to see another leg down in the stock market. So we have to keep that in mind. Is the number one rule of investing is we're going to see overreactions in both directions. And we saw overreaction to the downside. Now I believe we're in this phase of an overreaction to the upside. I'm happy things are reopening. I'm happy businesses are getting to start having revenue again, and that people are able to get out and spend their money. But economic reality tells me they're going to be disappointed. We're going to have another setback economically, especially if we have another setback on the virus. Because you know what? Science tells us that we should see the virus dissipate over the summer months. We should be able to go out and not see a big spike in the cases. We knew that about this virus from the very beginning. If you go back and listen to my first update back in mid-February, that was one thing I said was, this is a seasonal thing. The problem is if we don't have a good vaccine where people have confidence, we're going to see just this rolling periods of panic, which is going to be a drag on economic growth. And that's one thing that the market is not pricing in. But what we're looking at is, here we go back, I call it the myopic view of investors. Rick, my business partner and our founder, called it recency bias before recency bias was even a thing. The psychological term is called availability bias, which is basically your brains will remember what's happened the most recently or that had the biggest impact on your lives. And what market participants have remembered is every time the stock market dropped, you buy the dip. And that works until it doesn't. And one of the things that I keep pointing out to people is, look, the market definitely snapped back. They never got to a good value. We are not in a bear market. We never were in a bear market because a bear market is met with people absolutely hating stocks. I never once took a call from somebody throughout this crisis where they just said, I don't want you owning any stocks and I don't want you to own stocks for a really long time because I think things are terrible. What I heard was, hey, do you think Amazon is a good value now? Do you think this is that? Can I buy more stocks? That's not a bear market. That's a buy the dip mentality, and that's going to work until it doesn't. One thing that I think we have to keep in mind is stocks, again, very briefly, for about 2 days were attractively valued. When you buy stocks, you're looking at purchasing the future earnings streams of that company, or in this case, the entire stock market. What's happening is we're ignoring the structural damage that was done. So let's take a bit of time to understand that most people use a price earnings ratio. That's exactly what it says. PE is the price of the market divided by the earnings that they're generating. And that gives us a benchmark of, okay, where are we at now versus historical levels? Now, in December, we were at 21 times earnings. We're obviously not going to get the earnings that everybody expected going into 2020. Those earnings continue to come down. Right now, they're saying about a 30% drop in S&P 500 earnings. But we're being told to ignore that. And they're saying, let's use 2021 earnings to value stocks. Now, 2021 earnings right now assume that we're going to be 3% above where we were at the beginning of 2019. So not only are we going to replace everything that was lost, we're actually going to be above where we were at back then. And, as I mentioned, there's so much structural damage. I don't think that's possible, but let's assume they are correct. Let's say we're going to see a strong recovery. We get back to above where we're at by 2021. There's a thing called the forward PE. Now, I'm going to try to draw here on the chart here. Now, long term, the price earnings ratio using last year's earnings has been 15, and that's why I put long-term average there. I've also heard people say, well, during just a mid-cycle correction, so a quick recession, and we're going to go right back to the long-term trend, you'd see PE ratios come down to 18. So these are the two numbers I'm using. That's using last year's earnings. Using next year's earnings, the next 12 months, they call that the forward PE. That long-term average typically is around 14, which doesn't even show up on that chart. Again, that's using earnings 12 months out. Now, the 2021 earnings are obviously 18 months out, but let's give everyone the benefit of the doubt. Let's say, okay, we're going to assume 2021 estimates are correct. We're going to get a full recovery and a little bit of extra growth, and we're going to use the long-term average forward PE of 14, and we'll just round up and say 15. If you use that, stocks 2438, based on May 22nd levels, which looking at the market open here on May 26th, we're looking at an S&P even higher than it is right now. It's at 3,000. But based on those levels, we're 18 to 20% overvalued if we're going to get a full recovery and a little bit of growth here by 2021. So if you're buying stocks today, you're expecting earnings to be even better than what analysts are currently expecting. Otherwise, you're buying stocks that are 18% overvalued. Let that sink in. Stocks today are pricing in a perfect recovery and are still overvalued. What if we don't get that? What if we are using 2020 earnings? Now we're talking stocks that are 33 to 45% overvalued. If you look at what happened to earnings in the 2000-2002 recession, 47% decline in earnings. That means stocks are 65 to 71% overvalued. I'm not saying we get down there because I don't think this recession is as bad as 2008, 2009. I don't think it's as bad as 2000, 2002. But I also don't think we're going to see this big snapback and everything's awesome by 2021. So be really careful if you're buying and holding stocks here. One thing, the reason I am so cautious subjectively, we'll talk about what SEM's looking at here at the end. But one reason that I'm so cautious is Warren Buffett is cautious because the world's best value investor, arguably, and I'm definitely one of those people that says he is. If you noticed a few weeks ago during his annual meeting, he said, I'm not buying anything because there's nothing really attractive right now. So we have this thing called the Buffett indicator. It economically just makes so much sense because you take the overall capitalization of the stock market and you divide that by the economic output, and that gives you a ratio that tells you are stocks under or overvalued. And the economic numbers make sense because no company all the earnings that a company generates ends up showing up in GDP eventually. So there's no manipulation of earnings happening that you see often with the price earnings ratio. It's what's really happening versus what are you paying now. So over the long term, you cannot mathematically see companies valued more than the underlying economy. And so just understanding this, across the bottom is the Buffett ratio, so the market cap to GDP. And across the top is the 10-year annualized returns. And one thing that you'll see is, going back to what most people say the number one rule of investing is, buy low, sell high. When you bought at a low Buffett indicator, such as 2009, you will see that you ended up getting 14.5% returns. And we'll talk about that here in just a second, because you bought at a low Buffett indicator. All the times you've had really good earnings or for the next 10 years in your stock portfolios has been when the Buffett indicator was really low. Now, what's happened when you had market cap way above GDP? Well, we have that box down here. Anytime you've had negative 10-year returns, you got those because you started with a very high Buffett indicator. And you can look at here, 2000, you ended up, by the time you got to 2010, your returns were negative over that 10-year period. If you had bought in 2007 at the peak, you got slightly positive returns thanks to the returns we saw in 2016 and 2017 for the stock market. Before that, you were actually negative. So if you bought when stocks were at a high Buffett indicator, your 10-year returns ended up being very weak. And briefly, when March 2020, remember I said stocks were maybe attractive? We saw the Buffett indicator move here almost to 2007 levels. Now with the market rally that we've seen, the Buffett indicator is right back to where it was at in 2000. So this is saying we should expect very negative returns for stock portfolios over 10 years when you annualize or average them all out. But what actually happens, if you look at market history, this goes back to 1990, anytime we've had returns in the double digits over a long period of time, such as we've had here, we ended up with a sharp correction, and then you end up clawing your way back out. So for 18 to 24 months, you lose a big amount of money, 50 to 55%, and then you spend the next 7 to 10 years recovering that money. That's how you end up with a negative 10-year annualized return. It's not like you're losing 1% every year for 10 years. It's this big, sharp drop. And this is where I go back to saying, buy the dip works until it doesn't. As we get through the reopening process, and then we start to assess the economic damage and realize economy was here, we most likely are only going to be back to here. Stocks are pricing in a return to here. We're going to see that sharp correction. I don't know when that'll happen, but market history, my study of economics, and just the data tells me that that is very likely to happen, especially when stocks are priced the way that they are right now. Now, just looking real quickly at why this becomes important, I'd encourage you to go to risk.semwealth.com and check out our risk questionnaire, because it's actually more of a personality questionnaire. We have to understand that we all are going to be subject to different biases. So as we've digested the COVID-19 data, as we've digested the economic data, your personality will determine how you are reacting to this. And that becomes a very important driver of how we want to allocate your investments. But what's most important, ignoring everything I said about the economy, all those opinions that I just gave, also ignoring all the opinions that everybody else on TV is giving as far as what's likely to happen with the market, the number one thing you need to make sure you have is a solid financial plan, which then ties into a cash flow strategy. Because without those, we can't do anything with your investments. And that becomes important to understand that you need a financial plan, and you need a cash flow strategy before you even start worrying about your investments. What we do at SEM then is we choose to bucket out the money into a wide range of strategies. With SEM, you're really getting about 3 different money managers inside of one company. And then we'll spread inside of each of those money managers, or what we call management styles, different types of investment strategies to give you some diversification. That becomes really important because during the panic in March, we were able to point to our low risk strategies: income allocator, tactical bond, cornerstone bond, dynamic income, as already playing defense, protecting your money. That allowed you to stick to, and in a lot of cases, our clients added, they did Roth conversions, and they did their IRA contributions into their long-term buckets, whether it was dynamic aggressive, cornerstone or AmeriGuard growth, cornerstone or AmeriGuard max. Those long-term buckets, we saw clients adding money to those because they knew this is money they're not going to touch for a long period of time. But we blended the portfolios together, so you always had something working for you inside of the portfolio. And the way that's worked for our clients is, look, I can be, in fact, my nickname is Mr. Sunshine. I can be negative. I've mentioned a whole bunch of negatives that could happen there. I'm long-term bullish. I'm very optimistic. I understand that over the long term, stocks are going to go up based on economic growth, the dividend yield, and the rate of inflation. Now, that said, I think long term, we will somehow figure out a way to get back to 2 or 3% GDP growth. We'll see a 2 or 3% dividend yield. We'll see 2 to 3% inflation. So now you're talking about 6 to 9% returns over the long term for the market. But if you want to take a step back and you look at, well, what's our potential GDP growth? We're probably not going to get to 3% if you average it out over the next 10 years. We're probably going to be lucky to have 1.5 to 2%. Based on the structural issues that we're facing, as far as the debt we have to pay back, the demographic imbalances that we have, the shrinking labor force that we're seeing in our country. So you're talking 1.5 to 2% GDP growth. Dividend yields, we've seen those. Corporations were able to pay very high dividends because they had access to debt. That's being frowned upon, obviously, with all the stimulus money right now. It's also looking at companies we've seen already slashing their dividend. We're probably going to see the dividend yield at more like 1.5%. Inflation may happen, but as of right now, the inflation forecast is 0 to negative. The reason the Fed has been so aggressive with the things they're doing with the market is, or their stimulus stuff, is they're deathly afraid of deflation. Because every time consumers see prices going lower, it holds off their demand. They don't want to go out and spend money because they think prices are going to be lower in the future, and it can hurt things economically for a long time. So maybe we get back to 1% inflation. We barely had 1% inflation for the first 4 or 5 years of the last recovery. We're less likely to see that now. So we're talking about 3% potential growth for the economy over the for the stock market over the next 5 to 7 to 10 years until we correct some of those things. And then we're looking at much stronger growth. But all that said, long term, let's just assume 8 to 10% growth when you use that formula that we just talked about. What you're seeing happening is stocks are, remember rule number 1, stocks are going to over anticipate growth, and they're going to under anticipate growth. And so where we're at right now, just based on the long-term trends, when we started the year, I used this chart and I said, look, we're somewhere near the peak. I don't know exactly where, but that's where we were. And then we saw it fall actually somewhat attractive for those couple days in March. But if you look at long-term valuation trends, we're somewhere near the trend line. The best opportunities will come when we're well below that trend line. And that's where I put the "we are better off here" line there for the market. Now, let's take a quick look at where we're at as of May 22nd. Our tactical models are actually leaning bullish. You're looking at tactical bond, 100% invested in bonds. Most of those high yield bonds, we've talked about those opportunities. Those opportunities have been squished a little bit because of the Fed. We're going to wait for that default cycle to play out, and then we're going to have huge opportunities coming out of that when the economic reality sets in. But for now, we're very excited about where tactical bond is. Cornerstone bond is 40% in biblically responsible high yields, 60% biblically responsible corporate bonds. If you are a Christian, I encourage you to look at these cornerstone models. They have been stars this year. We launched them at the beginning of the year, and they've done great. A socially responsible or what they call an ESG approach, such as what we have with Cornerstone, has actually outperformed a more secular strategy. So Cornerstone bond is beating tactical bond this year. Not always going to be the case, but it's something to look at if you're a Christian investor. Income allocator, another core system that we have here, heavily invested in, even enhanced growth is 50% invested. If you look at our dynamics, they remain bearish, and we'll talk about that here in just a second. And then our AmeriGuard and Cornerstone are kind of right down the middle. So let's look a little bit closer at what we see happening there. Tactical bond, this also applies to Cornerstone bond. You could see, we don't have time to go into this whole chart here. We want to keep this under our 30 minutes here. But we have the sell signal that happened, and I haven't gotten, because this is only through March, to put our triangle. It happened right about somewhere there in the model, in the recovery. We don't think this is going to be a long-term signal. It's probably more if you go back to what we saw in 2008, 2009, when we got the buy signal on Christmas Eve 2008. It ended up being a nice 8 or 9% return before we saw another sharp sell-off in high yield bonds. We're probably looking at that situation, if not a few more times, because default rates definitely have just barely started to come up, and the spreads are not pricing that in yet. But we'll get there. The nice thing about tactical bond and Cornerstone bond is it can sell pretty quickly, as you see with some of these past sell signals in the model. The dynamic models, this is our second management style, uses our economic model. What I like about this is, one, how quickly it went bearish before anybody even had heard of coronavirus. It saw the weakness in the economy. But two, now that we've seen such a big sell-off, there's a chance for it to hook higher more quickly. So when the data starts saying, look, maybe the coast is clear for the economy, you're going to see our dynamic models begin to start putting into place more assets that like to take on risk. But even where we're positioned now, we're positioned very nicely, and we'll talk about that here in a minute. Finally, AmeriGuard and Cornerstone, they can now sell intra-quarter. It was something that we added with Cornerstone and then put into AmeriGuard. They're basically halfway between fully bullish and to their bearish positions. That can switch at any point. We can either put more in or take more out during the quarter, which is a little bit different than a lot of you are used to. And if you have questions on that, let me know, and we can talk about that offline. Now, let's look at what's happened. And this is what is important, is my opinions, Rick's opinion, Steve or Cody's or anybody's opinions here at SEM honestly don't matter. What matters is what the systems are saying. And so what we saw happening is, again, early 2019, we actually saw our dynamic models taking money off the table. Late February, we saw our high yield trend reversal. So we went into defensive positions there. And then our momentum indicator actually turned negative into the rally for AmeriGuard and Cornerstone. And that's because it's looking at the overall volume and participation of the markets and making a measurement there. Now, what we can see happening is we have a V bottom, which is what the market's pricing in. And we have a plan for that. When you look at our high yield bond trend, uptrend is confirmed. We're all the way in high yields. Dynamic income uses other high yield managers and fixed income managers. They're almost all the way in high yield. So we're in the early stages of the V bottom plan. If that continues to play out, you're going to see the stock uptrend confirmed by our AmeriGuard and Cornerstone models. They will look to then jump in to the markets. And then finally, the economic model turns out would be kind of that last confirmation of, hey, look, we got the V bottom, off to the races. The problem is, where we're at right now is, what if I'm right on my opinion about the economic data and we end up in a prolonged recession, well, we have a plan for that as well. You can see us move back to defensive positions or those models that are already there, staying there. You'll see if stocks move to new lows, Cornerstone and Amerigard taking the rest of that money off the table. And then once, though, everything bottoms out, we get to that true capitulation, we're designed to flip right back up. We have a plan for either direction and everything in between. And I think that's critical to understand is we reacted because the model said to. We have started to get back in because the model said to, and we will get back out if the models say to. There's no opinions that are influencing this. We're not guessing. It's not like I'm sitting here with my magic 8 ball and saying, well, is the recovery over? And it says without a doubt. So let's buy everything. That's not how we're programmed. We've been through all kinds of unprecedented events here at SEM in our history, and we're going to go through more. It's going to be scary at times, whether it's because of coronavirus or something else, but we're going to get there. And you know, one thing that I think we need to factor in here with the markets is we're here to be that source of stability. We're here to filter through all the noise. I'd encourage you to use our risk questionnaire, risk.semwealth.com. There's also a box at the top on semwealth.com to take our risk questionnaire, and stay tuned to the blogs because we're here to give you whatever we're seeing out there. We put out a lot of content recently, and I encourage you to subscribe, check in often, and we'll tell you what's happening, what we're seeing. And regardless, just know that we have a plan for what's happening in the market. So thank you for joining me. I'm sorry I went a little bit over time. Unfortunately, we don't have time for any questions. Definitely feel free to reach out. We have a contact us button on our website. Use the comment section of our blog. It's a way to have a conversation about me. If you're seeing something in the market you want to have a question on, or you want to debate me, that we have a new comment section on the blog. So use that. So until then, we'll check. You'll get notifications from us whenever we have a new update. Stay healthy. If you're allowed to get outside, get outside. Fresh air is the best thing you can have right now, regardless of what's happening in our economy. So thank you.